Investing 101. How should a beginner start investing? For newbies, there are various investment options available, including robo-advisors and beginner investor apps. But where do you begin? The most common myth about investing is that it is just for the wealthy and that you need a large sum of money to begin. This may have been true 10 years ago, but it is no longer true in 2022. Technology and advancement in the sector have eliminated all barriers to entry. With all of these developments, there's no excuse for newbies not to invest. So take these recommendations to get started. But first, have you subscribed to our YouTube channel? You won't want to miss out on the educational content we produce on a regular basis. Remember to press the bell notification icon as well. Let's get started. Number 1. Investing's Golden Rule. You should never lose money according to the rules. This rule was devised by Warren Buffett, an investment guru who has made a fortune by following it. The easiest method to achieve this is to invest when an option is undervalued at appealing prices. You will be paying less than the original amount, which will allow you to earn some big money once normalcy returns. While taking risks is exciting, be sure you only take measured risks. To reduce risks, avoid short-term investing. Instead, search for long-term investment solutions with stable returns. Rather than short-term trading, Warren Buffett has built his fortune through long-term investing. Some people have hit the jackpot through speculation, but an even greater number have lost money in the same way. Short-term trading has a number of costs that are charged in fees, as well as a number of uncertainties that can result in significant losses. Many other billionaires have made their fortunes through long-term trading, which is proven to be increasingly important over time. Number 2. Create a portfolio strategy. Define your goals when you first start out, which is how much money you want to make in the long term. What financial position would you like to be in? How much do you want your net worth to be? Ask yourself these questions ahead of time, then devise a strategy for getting there. After that, determine which investment possibilities are profitable and whose return rate will provide you with the revenue you desire within the time constraints. When making investment selections, keep this in mind. Number 3. Paper trading. Paper trading allows newcomers to gain real-world experience without risking real money. This method allows you to trade and invest in stocks, monitor gains and losses, and do pretty much everything you would in real life. Many platforms today will allow you to practice your skills for free. Consider this a training ground before investing with real money. I believe that every newcomer should begin here. After all, what have we got to lose? Number 4. Stocks. Buying shares in a single corporation as a novice can be one of the greatest methods to invest your money. You may make as much as 15% a year by investing in the right business. Warren Buffett has been milking the markets for the past 6 decades with the exact approach I'm about to reveal to you. So, how can a beginner investor get started? The most important factor is choosing the appropriate company and the right timing. This will involve conducting study on the selected company's prior performance, management, financial reports, and moat. Don't invest straight away if you've found a company that fulfills your criteria. Keep the company on your radar for a while. Keep an eye out for price drops while you wait. Buy when the stock price comes down. Once the company returns to its true value, you will have a great bargain and profit. It's critical to keep your emotions in check when investing. Recognize that markets are extremely volatile, and even the most successful companies can have downturns. Don't be alarmed or make hasty judgments as a result of any significant changes. Wait, be patient, and think about the circumstance before making a choice. Never allow fear to influence your buying or selling decision. You will almost always be wrong and doing exactly what the market wants you to do. The beauty of today's investing is that you don't need a lot of money to get started. You can start with $1,000 and quickly expand your account to tens of thousands of dollars. When investing, make careful to stay away from penny stocks. Penny stocks are company stocks with a market capitalization of less than $5. These stocks may be appealing due to their inexpensive pricing, They are, however, extremely volatile, with little to no information on the companies available on the internet. The majority of penny stocks are for tiny businesses that are fresh to the public market. Number 5. Apps for investing. Technology has arrived to save the day, or more accurately, to save inexperienced investors. There are various beginning investing apps available nowadays. Some even round up your credit or card purchases and invest the difference in an ETF portfolio. These apps will handle your portfolio in the same way as robo-advisors do. If you insist on doing it yourself, there are numerous programs available that will train and teach you how to invest. Most have low fees and are convenient because they can be accessed from any device at any time. Number 6. ETFs. Index funds and exchange-traded funds are very similar. They both follow the same market index and invest in the same way. When compared to mutual funds, these funds also offer lower fees. The key difference between the two is that instead of requiring a minimum investment, ETFs are traded continuously throughout the day and have a fluctuating share price. This share price represents the ETF's minimum investment amount, which can range from less than $100 to more than $300. Because they are exchanged on a daily basis, they incur brokerage expenses in the form of commissions. Many people have made a lot of money with them, but they necessitate a great deal of research and attention. You will need to devote a large amount of time, if not a full-time investor, to truly prosper with them. Number 7. Fund of indexes. Index funds are best described as mutual funds on autopilot. It's a fantastic alternative to paying a portfolio manager to do it for you. An index fund, on the other hand, will follow a certain index. A market index is a group of investments that reflect a portion of the overall market. The S&P 500, for example, has the stocks of 500 of America's largest corporations. The S&P 500 fund will invest in the stocks of companies in the category, mirroring their performance. The expenses are cheaper since the funds invest passively, following the broad market index rather than employing a true professional portfolio manager. Investing in index funds, like mutual funds, entails purchasing a portion of the entire market in one transaction. The majority of index funds have minimum investment requirements, while a few brokerage funds do not. Isn't that incredible? In the long run, this investing strategy is preferable. Number 8. Mutual funds with a set date. Target date mutual funds are similar to retirement plans. This investing option will invest money automatically based on your expected retirement year. A mutual fund is a collection of several investments in which one investor purchases a share of the fund and thereby invests in the fund's whole portfolio. These funds are managed by professional managers who decide how the money is invested, but each one has a certain theme. An equity mutual fund, for example, will invest in equities. The targeted mutual funds will almost always carry a combination of bonds and stocks. If a person expects to retire in 20 years from 2022, they can choose a mutual fund with a label 2042. The investor will receive the benefits of the investment when the period finishes. Number 9. Robo-consultants. These are robots that, as the name applies, provide financial services such as constructing portfolios and picking investment options on behalf of people. Robo-advisors are an excellent alternative if you don't know much about investing. They will use computer algorithms to manage all of your investments. Because their systems have low overhead costs, their operating expenses are lower than hiring brokers to administer your account. Using a robo-advisor will cost you between 0.25 and 0.50%, whereas hiring a personal financial advisor will cost you between 0.5 and even 5%. This is an easy way out if you are a beginner and don't have a lot of money. However, we are not suggesting that you delegate all of your responsibilities to them. You must still keep track of where your money is going and what is happening. If you're interested in learning more, several advisors have instructional information and resources that can help you understand the processes better. It's a less expensive, more convenient, and tested method of investing. Number 10. 401k plans or employment retirement plans. As a new investor, the greatest place to start is with a retirement plan. Some employers will match your contribution. For example, if you put in 2% of your salary, your employer may match it with another 2%. It may appear to be a little sum, but it is free money that will compound over time. If you are under the age of 50, you can contribute up to $19,000 to your 401k, and if you're over 50, you can contribute up to $26,000. The benefit of this investment plan is that there is no necessary minimum deposit. You may begin with whatever amount you can afford. When you choose a plan, the payment will be debited from your account automatically. Because most retirement plan deductions are done before taxes, you'll save a lot more money over time. Compounding also plays an important role in developing your money. Compounding allows a little monthly commitment to grow into a substantial sum in a few years. Still have reservations? For further information, contact your HR department. Overall, if you follow our simple investment recommendations, you should be fine. So where are you going to begin your investment journey? Please let us know in the comments. We'd want to know which option appeals to you the most. That'll do it for today. Please share the video with your relatives and friends. If you liked it, give it a thumbs up. And if you didn't, let us know what we can do better next time in the comments. Make sure you subscribe and click the bell button to get notified whenever a new video is uploaded. That's all we have to say. We wish you luck on your investment adventure. Until we meet again.